Welcome to De-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today, we're doing a deep dive into Crane NXT, that's ticker CXT. It's a really interesting company right at the heart of printing U.S. currency.
Yeah, very specific niche.
Exactly. And based on our research from this morning, September 24th, 2025, we're looking at what seems like a trifecta of positive news. But it's creating this massive standoff between the bulls and the bears.
Well, it's good to set the scene a bit first. You know, the big picture. The OECD, they flagged some long-term worries, tariffs and such.
Right.
But they also bumped up the U.S. growth forecast.
Right.
Mainly citing, all the AI investment happening.
Okay, so kind of a mixed bag overall.
Sort of. But what's interesting about CXT is its core business, that physical currency the government contracts. It kind of insulates it.
So it's maybe less tied to that immediate AI hype or the tariff concern.
Exactly. It offers a sort of counter-cyclical stability. They're not really playing the AI game directly.
No, they're literally printing the money, as you said. So our mission here is to figure out if the market's really caught up. Has it fully priced in these, tangible catalysts, these guaranteed earnings drivers?
That's the key question.
Okay, let's unpack this trifecta then. What's the number one driver, the biggest piece?
That would have to be the Federal Reserve. They've put in a really substantial print order.
Okay.
And specifically, it's for higher denomination bills, 50s, 100s.
And why does that matter? Is it just more volume?
Well, volume, yes, but it's more about the margin. Higher value bills need more complex security features. Think special inks, sensors, that kind of thing.
Got it. More complex, higher cost for the Fed, better profit for Crane.
Precisely. And that's why the company's now forecasting high single-digit revenue growth for its U.S. currency business in 2026.
Wow. Okay, high single digits. That's pretty specific guidance based on this order.
It is, and it leads right into the analyst view. D.A. Davidson, for example, they immediately reiterated their buy rating.
Right, I saw that. And an $85 price target?
Yeah, $85. And they explicitly cited that Fed order. They see it as fundamental validation for the stock.
So you've got the big government contract, you've got analyst backing. What's the third piece of the trifecta?
That's the strategic acquisition they made. They bought a company called Antares Vision.
Okay, Antares Vision, what do they do?
They're in the life sciences space. This move is meant to significantly boost Crane's presence there. And importantly, it's expected to be accretive.
Accretive, meaning adding to earnings.
Yes, boosting earnings per share, likely within the first year of the deal closing.
So guaranteed government revenue, analyst buy-in, and an earnings-boosting acquisition. Seems pretty compelling, fundamentally.
It does. And when you look at how analysts value this stuff, using discounted cash flow models or DCF.
The gold standard for valuing future guaranteed cash, right?
Exactly. Those DCF analyses consistently put the fair value somewhere north of $75 a share.
And the overall consensus?
It's firmly bullish. About 2/3 of analysts covering the stock have a buy rating. And crucially, there are 0 sell ratings right now. The street seems convinced the value is there.
Okay, fundamentals look solid, even strong, but let's talk sentiment, because this is where things get, spicy.
The tug of war.
Yeah, the options market looks incredibly bullish. We're seeing a put-to-call ratio of just 0.11. That's extremely low.
It really is. 0.11 basically means, for every bearish bet, every put option, there are almost 10 bullish bets, call options.
10 to 1.
Yeah, and those call options, they're clustered. It suggests traders are looking at $60 as this really key psychological floor. That's the new support level.
Okay, so options traders are betting big on the upside, seeing $60 as a base, but then you have the short sellers.
And that's the big counterpoint. A really hefty chunk of shares, 14.41% of the float, are sold short.
14.4%, that sounds like a lot, is it?
It's substantial.
Yeah.
Very substantial. And think about what that means practically. Based on the stock's average daily trading volume, it would take those short sellers almost 14 days just to buy back the shares they've borrowed to close their positions.
14 days to cover, that's huge.
It's a massive days to cover metric. It sets the stage for a potential short squeeze.
Explain that a bit more, the squeeze potential.
Well, if the stock starts moving up decisively, maybe breaks a key level, those short sellers might panic. They have to buy back shares to limit their losses.
And that buying pressure itself pushes the price higher.
Exactly. It can become a self-fulfilling prophecy, a rapid, almost explosive move upwards.
Yeah.
They're essentially betting against the U.S. government needing money printed. It's a bold bet.
A very bold bet. Okay, so we have this fundamental strength versus this massive short position. what are the technicals saying? Is the chart confirming this battle?
It absolutely is. Just recently, the stock staged a really sharp reversal. It broke out upwards.
Even though the shorter-term trend had been negative until, what, yesterday?
Correct. It broke that recent downtrend line. And importantly, look at the volume.
What about it?
It spiked massively on the way up. This wasn't some quiet drift higher on low volume.
So real money flow behind the move, not just noise.
Precisely. It suggests conviction, institutions, maybe hedge funds, stepping in. It's not a low-volume head fake. This looks like real buying pressure.
Anything else, technically?
Yeah, volatility, it has exploded, shot up to a new relative high.
Which means?
It confirms this isn't just business as usual. The market recognizes this inflection point. The battle between the bulls, who see the fundamentals and the Fed order, and the bears, dug in with that huge short position, is officially engaged. Things are getting heated.
Okay, so putting it all together, we've got guaranteed fundamentals, strong analyst support, bullish options activity, all running headfirst into this enormous wall of short sellers who could get squeezed. Our analysis has to land somewhere.
It's a fascinating setup.
We're calling it cautiously bullish.
I think that's fair. There's a clear path higher, but that short interest adds a layer of, well, potential fireworks and risk.
So for you, the listener, what are the key levels to watch? Where's the battleground?
Okay, the key level the bulls need to conquer and hold is $66.24. If we see a sustained close above that price,
That signals they're taking control.
it suggests they might be gaining the upper hand. Yeah. And it could start putting serious pressure on those shorts, initiate the squeeze dynamics.
And the downside, where does the bullish case fall apart?
The critical support level is that $60 mark we mentioned, the psychological floor the options market seems to see.
Right.
If CXT closes decisively below $60, it suggests the prior downtrend might be resuming. It would validate the bear's thesis, at least in the near term.
So $66.24 on the upside, $60 on the downside. That's the range to watch.
Those are the lines in the sand right now.
All right, final thought then. Crane NXT, a company whose actual business is printing money, just got a huge new order from the government to do just that. The big question is, can it print money for its shareholders too?
That's what everyone's waiting to see.
That's all for this episode. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.